Hi guys, welcome back to the channel. My name is Dave, and these 7 stocks right here are known as the Magnificent 7, and for good reason. They have lifted our market here in 2023. If you had an ETF that did not include these 7, you're probably not very happy. But by putting these into the S&P 500, well, it looks pretty good overall. But what if we could harness the power of these 7, put them all, smush them all together, put it into one ETF? What would we have? Well, we would have MAGS, the MAGS ETF. So today I want to take a look at MAGS and see if it makes sense for a portfolio or if there's another way to approach investing in these 7. If that is what you're looking for, please stick around. Whoop. So let's start out by talking a little bit about these 7 stocks. And this is an article from Yahoo Finance by Josh. First of all, he points out what they are. They're Apple, Alphabet, Microsoft, Amazon, Meta, Tesla, and NVDA. They make up 29% of the S&P 500's market cap. So these are the behemoths in the S&P 500. But I love the chart here. This is from Goldman Sachs that they split out, where they show that the 7 stocks that we just mentioned, that Magnificent 7, has returned 71% over the last year. Now, obviously that's not going to happen every year, but I'll take 71% this year. That would have been amazing, right? If I was in those 7 stocks by themselves, 71% return, outstanding. You can't ignore it, right? Now, overall, the S&P 500 has done well, so we can keep it really simple and we can just buy that S&P 500 index ETF that we like and get a 19% return this year. That's pretty darn good. But if we strip those 7 out, we're going to see that performance falls considerably, all the way down to 6% for the remaining 493 companies. Such a huge separation. So obviously these have done the heavy lifting. So the article goes on to point out that from 2013 to 2019, going back a ways, the Magnificent 7 stocks grew at a compound annual growth rate of 15% compared to 2% from the rest of the pack. Amazing, right? Now that margin narrowed in the past 2 years to 18 and 15%, but Goldman sees that widening again. From 2023 to 2025, their expectations are to see the Magnificent 7 growing at a compound annual growth rate of 11% to 3% versus the rest of the S&P 500. So huge outperformance. Again, going forward is what their expectation is from Goldman Sachs. Finally, the last part here is the Magnificent 7's profit margin, 19% versus 9.8% for the rest of the companies, not to mention the long-term earnings per share growth expectations are 17% for the 7, while that number sits at 9% for other companies in the index. So where should we be putting our money going forward? Well, perhaps it's with MAGS, the Magnificent 7 ETF. This comes to us from Round Hill Investments. So all this has in it is Apple, Microsoft, Alphabet, Amazon, Meta, NVDA, and Tesla. That's all it is. Really simple. Overview. The Round Hill Magnificent 7 ETF offers investors precise exposure to the Magnificent 7. If we zip down here to the bottom, we're going to see exposure and documents, and we're going to see the weight currently for those 7 stocks. And you can see that Microsoft's been the best performer this last quarter, and Tesla has been the worst. Now, how do you feel? It's going to be equally balanced. They're going to rebalance this every single quarter, and that is your product. That's it. They're just going to focus on this. So you definitely want to make sure you're in bed with all of these, which I have shares of everything on here, and individually, as well as through ETFs and things like that, with my smallest one being Tesla, and my largest ones being Apple, Alphabet, and Microsoft. So I've got a large concentration of individual shares with those 3. So if we zip over to Seeking Alpha, and I am a Seeking Alpha affiliate, there's an affiliate link down below right now. They're having their special. I'll put that up real quick. I won't talk about it anymore, but it is a good offer. I do love this product. I use it all the time, every single day, as I screw around looking at ways to invest my money. Now, this is MAGS, Round Hill Magnificent 7 ETF here on Seeking Alpha, and you can see the performance. Now, it's only about 6 months old. It hasn't been around for very long. And you know what it is. They rebalance those 7 every single quarter, and that's what you're going to own. Now, the expense ratio here is 0.29%. So it's kind of expensive for what it is. And the assets under management right now is 14.66 million. So they don't have a whole lot in this ETF currently, right? So that's not a big ETF, but definitely has some investors. But that expense ratio of 0.29%, if you wanted to do this yourself, you could easily set this up on something like M1 Finance, where you went in and you said, buy these 7 equally weighted, and you click the rebalance button. That would be very simple if you wanted to save that 0.29%, but I get it. Not everybody wants to do that. Some people want to be very hands-off. They just want to buy it. They like the fact that they can buy it for $32.64 and put a share in their pocket, dollar cost average, into something like this. These 7 stocks they know and they hear about every single day. So if you want to keep it simple, MAGS might be an option for you if you're okay with that expense ratio of 0.29%. Now, not a whole lot to look at here, but you can see the early performance looks pretty good as those 7 stocks have performed pretty well. We could go out and we could look, see if I can get this centered for you, at year-to-date performance. Actually, go to 6 months. So we can kind of see where it's been. There are going to be undulations with this. There's going to be a higher beta with something like MAGS versus the S&P 500, but you can see it's kind of springboarded here late October into November and outperformed the S&P 500 over here since it's been come online just 184 days ago, or about 6 months ago. So that's it. That's MAGS. That's an option if you really want to focus on these 7. Now, I will give you one other alternative. You could look at something like MGK, which is the Vanguard Mega Cap Growth Index Fund ETF shares. So now we're talking about Vanguard, a similar product, but it's not going to be rebalanced like that. It's going to be market weight. And you're going to see that the expense ratio, because it is a Vanguard fund, is extremely low. So in this case, not the same, but if you want to exposure to these 7 stocks and other things, like I would be on board with this one, right? 0.07% expense ratio, very low. It's a large fund, over $13 billion in this fund. And if we click just to look at holdings, just as a comparison, if we slide down here and we take a look at this one and we look at the top 10 holdings, you're still going to see all those stocks in here. But again, you're going to have a much larger exposure to Apple and Microsoft, with those being the largest, followed by Amazon, NVDA, Alphabet, Meta, Alphabet, you can combine the 2 there, and Tesla. So altogether, these top 10 make up 62%. If you just take out these last couple, it's still going to be about 55% or so. So you're still getting a lot of exposure to those 10 if you wanted to do something through an ETF like this. Again, that's MGK. And that's probably the way I would do it versus buying MAGS. But if you want to focus on it and you're willing to pay that little extra commission, have at MAGS. So what do you think about MAGS, or the Magnificent 7 in general? My personal view here is that if you buy these, you won't be disappointed in the long run. You might have to wait 4, 5, 6, 7 years. But if you start to dollar cost average into these big guys, I think you're going to like your position here down the road. At least that's my personal view. After all, my largest holding is Apple. Now, if it hits $200 a share, I might start selling calls. I might lighten up my position a little bit. But overall, I love that company. Same with Microsoft. Same with Alphabet. Those are my second and third largest holdings. Been building my NVDA shares up here slowly. Meta, I got a little bit. Tesla, not a big fan. I just have a very small holding there. And yeah, I think all these, and if you group them together and bought them, again, I don't think you'll be disappointed in the long run. Although 2024 might be a big disappointment as you give a bunch of that 71% back. Who knows? But I'm okay with that because I still have a time horizon. So let me know what you think down in the comments. I'd love to hear. And if you like this type of content, like and subscribe, and we'll see you next time. Take care. Boop.